Hey everybody, we're here live with the Gold Rush. So much going on today. Obviously, everybody's either feeling pain or excited because of their shorts. Even gold's feeling a little bit of pressure today. Silver's feeling a lot of pressure. So, let's talk about it today because there's a lot of stuff going on right now, a lot of things we can talk about. But let's take it to the charts. So, Sam, how are you doing today, man? And what are you seeing out here in the market?
I'm doing well, Jason. Thank you. There's a lot going on today. No shortage of topics. I'm seeing a lot of FX moves, a lot of bond moves. Those certainly have my attention. Stocks are certainly moving, but the big money is really concerned with these moves in foreign exchange markets and bond market. The
Yes.
bond market relative to the stock market is what is it? Twice the size, three times the size. So.
It's the most important market in the world, and it's what, we can kind of measure liquidity from. It also helps us to kind of see safe haven demand or inflation. So I love looking at the bond market for all of those things. But, looking through just today, we're seeing a lot of volatility in some of the areas that were leaders, some of the laggards. And I think something that's important to kind of say about that is that this is a very normal type of move in a liquidity event. And what that means is when you see the S&P 500 down, let's say 3%, you start to see a number of names, individual stocks down something like, 7 to 10%, even 20% for some of these big names. That's a point where you start to see these liquidity crunches. And what that means is that people have to sell anything to make things work. So basically, let's say you're at a brokerage, you have a margin call in something because it dropped so much overnight. You've got to start selling other things to basically cover it. And most of the time, those sales come from the winners, unfortunately. So things like gold will get sold off, things like silver will get sold off. Obviously, silver is being sold off pretty heavily right now. So, this is a very normal event in markets. Sadly, I know it's happened in an uptrend. A lot of people got caught. But to me, gold being down 1%, that tells me that that's a pretty good thing to hold right now. Probably great for this environment still going forward. The gold miners tried to do a catch-up move at the open for a little bit. So there is still a lot of interest out there in gold and silver. And still, even when you look at it year to date, it's still outperforming everything
Dramatically too, not just
dramatically.
by a little bit.
Yes.
And on the margin call note, I think that's a great point you made, Jason. But um, it's very important to remember that the margin clerks do not use limit orders. They're just spraying the market with market orders. They need to get this shit off the books. So they don't care what price these people that are getting margin called are getting. They just are selling without end, it seems like at this point. But
Yes. Just
it will end
completely.
eventually.
It will end, and that's the thing. It's gonna end. And the thing that I find very interesting about this setup, and we're not gonna stick too much on equities today. We're mainly gonna get into commodities and gold, but a little bit about equities is when you see this type of selling into an already oversold sentiment wise market. I don't like using sentiment for tops. I do like using it for bottoms. This is a scenario where this thing is either going to get bought up at some point or we're going to see a bounce. That doesn't mean we can't go lower afterwards. It just looks like, you have all these extreme readings over and over and over again, whether it's sentiment reports, bull bear reports, and so on. You keep seeing these extreme readings. At some point, you're going to see a bounce. Even if there's bad news. And the thing that I think about this situation is what other news could be worse than what happened yesterday? That's kind of the thing I'm kind of sitting on right now and thinking about. I don't have an exact answer for that just yet, but thinking about that, that's something to think about. Like all that could really come out now is other countries are bringing down their tariffs and we're negotiating or something. I just can't see anything being worse. But once again, I could always be surprised. You never know if
Well,
somebody's
couldn't
going to double
these
their tariff.
countries retaliate against us?
They could retaliate. Yes.
Trump was calling these tariffs nice. They were like half the rate of what the other countries are charging us.
Yes.
And I don't know how true that is, but
It's not. It's because of the way our imports and exports are, and the reason why the fees are. I believe a tariff rate for everybody should just be zero. I think free trade is probably the best way to go for most of these countries. But once again, that's not the world we live in. So people use these as negotiating tactics, ways to raise cash flows, whatever it is. There's a lot of reasons why people put tariffs on in the world. I think it's all ridiculous, but at the same time, I do think that we saw probably the worst shocking news that we could see of the tariffs so far. I can't see it getting much worse. But once again, retaliatory tariffs, other people getting mad, Donald Trump getting mad again, trying to do something more. There's other things that can happen, but I just don't see it getting much worse than it is right now based on the level of sentiment that we've already seen. Now, once again, it's not a go buy a position, start buying this dip and so on situation. It's a let's wait and see. If most of the time when you see a big event, for example, Fed Day, Fed days are always on Wednesdays, just like this one. So at a Fed day, I would go, okay, Fed day one is Wednesday. I don't know anything. That's how I always feel because the market's jumping around, it's doing whatever it thinks it should do. Thursday, you start to see a move that's volatile one way or another way. And then Friday, we kind of get a good understanding of what's actually happening. So I think that Friday we'll probably really know what's going on here. If we're going to see a bounce, we'll probably see it Friday or Monday. Right now, I would just say sit on your hands, don't take positions. A good time to just chill out.
Definitely, Jason. And I think one thing that a lot of people are interested in is how you can identify a potential market bottom. Sean has been talking a lot about how he has not seen enough volume on the up days compared to the down days. And today you're seeing a massive spike in volume across the board. So that is just confirming the down move. Is that something you consider when you're trying to pick a bottom? Is the volume, or what are you looking for? Are you just looking for the price to go up?
So that's
you're
a great
trend
point.
follower at heart.
So as a trend follower, I don't care. That's the
Yeah,
thing. Like I'll talk about it. I have systems and strategies that actually do try to identify those based on sentiment, based on volatility, and so on, even volume. But the problem is, like most of the time, the down moves, you're always going to see more volume on the down moves than the up moves. So, I don't understand when people say this is, I'm not seeing enough volume to say it's a bottom. It's how bottoms always happen. There's usually not a ton of volume right at the bottom, at least outperformance of volume, meaning the last red candle, let's say you had a lot of volume on that candle, and then the green candle, you see the green volume bar isn't quite as high. That's pretty normal. That's kind of what's always going to happen no matter what. So I wouldn't say that volume is the way to do it. I would just say the way to really identify a bottom is to not identify a bottom. Go go do something else
I
like
like
we're
that.
talking about today. Yesterday for me it's I made a post yesterday on Against All Odds Research, basically talking about, hey, we got this kind of setup here. If we get above blank level, I would buy this thing. We were nowhere near blank level. We never got above that level. So it's not worth buying. So once again, don't look to buy bottoms. Look to buy a higher low. Look to buy when we break out of a little bit of resistance, because trying to catch a falling knife is just a way to cut your hands up. No real reason to do it except for glory. So you could say, I caught the bottom. I am the best trader ever. That's the only reason why people say it. Like people will write like you'll see new traders do it all the time. They post on like Twitter and they're like, "Oh, I caught the bottom today," like, or I bought at this number. Like, and they'll send you it too. Like I get traders who hit me up all the time to send me messages like, "I bought right here." Why did you tell me that? Did you tell me that because you want my opinion, or are you telling me that so we can go back in a couple days and you can say I bought right here? And so, once again, just stay away from bottoms. Not something you need to do in markets. Stay away from tops. Not something you need to do in markets. Try to catch the meat in the middle. That's where the money's made.
For sure, Jason. I think a lot of the time when you see those posts like on FinTwit, also like it's a very insignificant amount of money that these people are buying at the bottom or selling at the top. We're here to make money. We're not here to be right, Jason. We don't care if we catch the bottom or top. Like you said, we just want the meat of the move, and we want to have as much money in there as possible too. 'Cause we're trying to make money here.
Yes. It's fun to talk about though, like for me, I talked about a post where, I had a trader who actually was pretty good at catching bottoms as part of his style. And, I talked about how he did it and the possibility of a bottom setting up. Like it's fun to talk about, but in reality, it's like, how do I make money? And none of it has ever been buying a bottom. I might sell some put options at some point. We have a system that does that. That's it. That's it. Selling a nice spread, hopefully making a couple bucks on the spread. Once again, it's not something that really makes our year. It's just something to do in volatile environments, and just move on from there. There's really not much to do.
For sure. Well, do you want to talk about what's going on today, Jason?
No,
Should we get
Sam. I
into the
want to
charts?
stay on the bottom topic for the rest of this. Let's do it.
Cool. Gene, if you can pull up the charts, we'll start with slide number 2 here. And this is just a performance chart of today's action so far in the futures market. As you can see, the VIX futures are the biggest winner today, obviously. They're up over 20% so far. And you have cocoa, Japanese yens, Swiss francs, and natural gas up there at the top. And at the bottom, you have lumber, silver, RBOB gasoline, Brent, and WTI crude oil, all down well over 5%. Jason, what does this mean to you just from a tape reader's perspective? You know, lumber being the biggest loser, that's pretty clearly just a message from the market that we're seeing potential deflationary shocks. You know, tariffs are not inflationary; they are very much deflationary. So,
Well, it can be inflationary and it can be deflationary. It can start off very inflationary and then it can move to deflationary very
it
quickly. So
seems to be deflation, though, is what the market's telling us today.
that doesn't, once again, it's a 1 day thing. We can't
Yeah.
say anything. We'd have to look at this like in the next 5 years. That's a problem with these type of things. It's a problem with economists why they really don't know anything is because they're like, in 10 years we'll figure it out. And that's the truth. Like we won't really know exactly what type of damage. I can only go back to like the Smoot-Hawley tariffs, in the 1929, 1930, and then the tariffs that JFK put on, and so on, and kind of dissect what happened to markets after that. Because a lot of people don't know that, yes, there was a huge deflationary shock in 1929 and the Great Depression, but then we actually started to have inflation. Part of the reason why the gold seizure happened in 1933. So it's a really interesting dynamic and something that you and I have talked about too, Sam. Whereas I said just the other week on the Gold Rush Live, no, not live, the Gold Rush show we do for our paying subscribers, we talked about the fact of a liquidity event. And I said, I have two, and I've had this opinion for a while, which is there's two scenarios that could play out here of huge deflationary shock where we see everything go down from lumber to stocks to gold, even. We see a huge liquidity event and a deflationary shock. Then it leads to inflation. Or we see a situation where inflation just continues to kind of build slowly and then really take off. So I'm kind of sitting over here going, I don't know exactly what today means because it's 1 day. Could be a huge overreaction. Lumber market is very easy to move around. This isn't that abnormal to see a big move in lumber in 1 day. But once again, everything has made these moves in different directions, but the dollar's down a lot. So most of the time in these deflationary shock environments, what is actually the biggest driver of that? It's the dollar, but the dollar is moving down today. So what does
Yeah,
that
well, that's
tell
our
me?
next chart. So let's pull
Yeah.
that up.
So what is
Dollar's
that
getting
telling?
slammed today.
Yes, it continues to get slammed. We had a huge rate of change week just pretty recently,
The euro just had its
beginning of
best
March.
week since the great financial crisis.
Yes. So we continue to kind of see these setups where it's like, okay, is that deflation? Because or is it a situation where we can actually have deflation in the United States without the United States dollar going higher? That would be wild. But once again, I would continue to kind of look at this and go, hey, the dollar is moving lower here. Liquidity is loosening up. The Fed's talking about stopping quantitative tightening. There's possibly some rate cuts coming in. There's a situation here in a scenario for a big move higher in inflation, but there's also a panic event where Donald Trump's kind of coming in. The first years of elections are always volatile. Presidents come in, and this is why if you go to year one election years on any seasonality chart, you see they're just up and down and up and down. It's frustrating.
Well, the last, I don't know, 30, 40 years, they've been a lot less violent to the downside. You know, if you go back to like the 1900s, the early 1900s, that is certainly the case. There were some really terrible post-election years.
But it's in the recent ones weren't too bad, but
Yeah.
either way, it's still volatile. So they go up. They're mainly up still. They used to be down. Now they're up, and they're also very volatile. So, and that's usually happens in the first 4 to 6 months. And what that is, says to me is, as the new president's coming in, they're trying to basically say, I have all these campaign promises to, let's say, big companies, let's say my constituents, let's say voters, whatever you want to say. Um, and they're making all these campaign promises. So trying to keep those and doing whatever they have to do that to move forward to kind of put their stamp on history. So we kind of see that the first 6 months of a year one president. So I think this is very normal price action. But I think the thing that's kind of sticking out to me is the dollar. The dollar really kind of shows me that, is this really as bad as it looks, or is it really bad for the United States and good for other areas? And not even bad for the United States in some of the stocks that are like gold miners or even possibly energy stocks are getting slammed today, but maybe at some point those pick up. The down dollar environment can be good for a lot of things. Sam and I aren't big on the energy stocks right now, but we're pretty big on copper miners, gold miners. Like, this might just be an opportunity to buy those, especially if we're in a weak dollar environment.
For sure. And I think very much along the same lines of a weaker dollar, we're seeing lower bond yields. This data is not up to date. Today, this chart is blasting lower, resolving this pretty textbook head and shoulders formation. I think you're going to have a 10-year yield below 4% here before long. So what does that mean for your uh, whether you think we're in an inflationary or deflationary environment,
So for
and
me,
if we should
this
be favoring gold or copper or oil or so on?
I think it continues to look at favoring gold. I think we're going to continue to kind of see that. I think copper is saying that at some point that's going to change. But I also think right now, like, don't fade gold. Don't think because it's up here, it's going to just crash. I think gold is still probably the place to be, especially if we are getting this more of a almost stagflationary shock where yields
Yeah,
are falling and the dollar is falling right together. That's sort of a great setup for a stagflationary type of period where you start to see gold start to really do well, but things that are kind of driving the economy like oil aren't going to do quite as well, and it's been saying that all year long. So I do think that the scenario is in play for a deflationary shock straight to a nice move higher. But once again, it's a really be careful here. So many people are going to just go out and try to buy things and think things are on sale and so on. It's just sometimes you got to really just sit on your hands. That, to me, there are no signals today. I don't have any new signals. It's not telling me to buy things, not telling me to sell many things. I'm just kind of sitting on my hands at the moment. And I think that's good advice for everybody until you know where this market's going to end up. Nobody knows the future for sure, so I'm not saying you're going to understand it with perfect clarity. I'm just saying, like, today's a panic day. There's a lot of people panic. There's a lot of people going, I got to get out of these things. We're all going to lose all the money in the world. And most of these people aren't like Sam and I. They don't own gold or anything else that's done well this year. So they're looking at a down year becoming even worse. And I'm talking about the funds and retail. And so they're just going to panic and sell whatever and freak out. And probably some funds are going to blow up and so on. But for people like us, diversified, holding gold, possibly looking for dips to buy in the gold miners and so on, I think is a great play here.
for sure, Jason. And I was just looking at today's action, and we have the Dow Jones Transportation Average down 8.5% now at the lows of the day.
Wow.
That is the worst day since March 2020. Um, so another move I've noticed today is in credit spreads. You have so that's we use HYG over IEI for a little shorthand for credit spreads. There's a lot of different ways you can measure credit spreads, but uh, for all intents and purposes, this gets the job done. And this spread is having its worst day in years, potentially the worst since the 2022 lows. And as you can see on this chart, it's also breaking below the prior cycle's peak after it had broken out. This was one of the biggest charts in the bulls camp. Credit spreads breaking out to new multi-year highs is incredibly bullish, but to see it reverse so decisively back to the downside, there are a few things that I can think of that are more bearish. What do you think? Does this mean there's some type of credit event coming? There's some, I think, like Bank of America, some of these other banks are just getting absolutely hammered. Like looking at 10% down in the Bank of America. It hasn't done that in years.
I think this is the hard part, and it's kind of like, when Sean says very wise things, I think a lot of people miss that stuff. When Sean's like, yeah, I don't see the volume. What he's actually saying when you read between the lines and hear him talk a little bit more, are things like, we don't have enough data yet. And also the other part, I don't mind buying higher. So once again, we don't have enough data just yet to really say, hey, this is it. But I do think that, and those aren't fun calls. Nobody likes to hear that. People want a very decisive, I know this is going to happen, but I promise you that's just not how trading works. I wish it did. Life would be a lot different for everybody. But once again, there's always a winner, there's a loser. But if we look at this chart, I do see that we're still in a series of higher highs and higher lows. I don't think that this looks as bad as, okay, we just broke a level, we're going to go straight down here. I do think that the big banks look fine. The small banks don't look great. So once again, be very picky about what you're choosing right now to have in your portfolio. I would be going quality over everything at the moment.
For sure, that's definitely the theme right now.
Yes.
Berkshire Hathaway is not having any trouble with this.
Yes.
And Berkshire Hathaway is $1 trillion stock. It's part of the Mag 7.
Yes.
So there are
continue to
Mag
do it
7s
that
out there.
way. That's the way I think that everybody should be looking at the market right now. Instead of looking at it like, okay, well, I can't buy tech stocks, I can't buy this. Like, it's like, no, there's international names that are doing well. Now, I think Mexico's up 4% today or something crazy. China's not down that much. The reason why we've done well this year in the fund is that we've been positioned so diversified that it hasn't mattered that much. Because if you just look at the individual names and if you look at the US and you look at big tech only, you're going to get stuck in that, like, yeah, everything's down, everything's hard to trade right now. But if you look globally, you get into a situation where you're like, yeah, there's some things that look really good and really promising. And like Sam said earlier, just the other day, gold having its best quarter since what, 1986?
Yeah, that's right, Jason.
I mean,
Yeah, I'm
nobody's
glad you brought
talking
that
about
up.
that.
I haven't heard anybody mention that data point.
That's a headline on Bloomberg and nobody cares. So I'm just, telling all you guys, a good idea is to kind of look through this, get an understanding that, hey, my biggest thought here is I don't want to be in the S&P 500. I don't want to be in big tech. I want to keep looking at these other areas and finding opportunities. This could be just another opportunity for people to buy some of these gold miners that they lost out on. This could be an opportunity for all those people who were like, oh my gosh, silver, I can't buy it here, to buy silver again. Now, once again, wait for it to bottom, wait for your signal and so on. But I think that's all these periods do is breed opportunities. And you have to look at it that way as a trader. Because if you look at it any other way, you just get depressed. And there's no point. There's always a new opportunity that will come. And a down market usually breeds new opportunities.
For sure. And we are seeing a lot of the same stuff, like a lot of these consumer discretionary stocks that have been doing very poorly. It hasn't just been a week or a month. It's been quarters at this point that consumer discretionary has sucked. And you're seeing like Restoration Hardware down over 40% today.
Yeah, I can't hear Sam.
My back?
You're back.
Cool.
We got Sam.
Sorry about that. No, I was just
You're good.
saying that we're trend followers, Jason. These absolute and relative trends tend to persist much longer than anybody expects. And that's why we have such a massive opportunity to make money is these trends persist for a very long time. And one that's been going on for over a year now as the gold futures broke out to new all-time highs back on March 4th, 2024. And they're up significantly since that day. Gold is now above $3,000 per troy ounce. I think if you're looking at kilos, gold is above 100,000 for the first time in history. It just keeps breaking records. And if history is any guide for the future, Jason, I think this bull market has legs. I think it has several more years left in it, at least. And you can see here that gold rallied 600% from its 2001 low to the 2011 peak. So that was about a decade of a bull market. In this current cycle, gold bottomed in 2015, and so far it has rallied about 300%. So it bottomed at around 1,000. I think that was around late 2015. And here it is above 3,000. So what do you think, Jason? Are people just going to keep buying the dip here in the gold futures and it's going to keep going for years until that 8,000 or so level is reached? Am I crazy?
I mean, you're not crazy, and it's a tough one, right? Where it's like, how is this happening the way it is? And if you look at gold, historically, this is kind of how the moves really happen in gold. People get really hyped on it and moves up very quickly over short periods of time. Um, but the other thing that we're seeing this year is we're seeing a lot of central bank demand. It remains robust. Emerging markets continue to accumulate. We're also seeing, the GDP for these countries in the emerging market space is up 4.2% last year. So they're having a little bit better GDP than the rest of the United States. Or sorry, not last year, year over year. And then the United States, and then the developed nations are at 1.8%. So, we're seeing this massive demand in the emerging market space, meaning China, India, and so on, where they're buying a ton of gold. There's a lot of geopolitical premiums baked in, whether it's Donald Trump and whatever he's doing, the Middle East, and so on. And it's not because it's exactly what's happening that's making gold go higher. It's because of the uncertainty. Markets hate uncertainty, and gold loves uncertainty. So when people don't know what's going on, they always kind of turn back to gold. It might just be something that's baked in us from using gold, going back to the beginning of time for trade, or it might be something about gold being looked at like a safe haven. There's a bunch of reasons why, but once again, it's just what happens when there's uncertainty, when markets are under pressure. People like to run to gold, and even if gold is getting sold off in a liquidity event, just like today, it's going to go down a lot less than everything else.
And that's certainly what I'm noticing, Jason, is gold relative to the S&P 500 has been screaming higher. And here it is once again today, printing fresh 52-week highs relative to the S&P 500. And you can see in this ratio, this outperformance, once it starts, it can last for a very long time. And it works in the exact opposite way too. Gold sucked after the financial crisis when gold peaked in 2011. It did absolutely nothing for years. It underperformed from that 2011 peak all the way to when it bottomed in 2020 and 2021 relative to the S&P 500. And as you can see, right after not the great financial crisis, the dot-com bubble in the early 2000s, gold outperformed stocks for over a decade. So do you think this outperformance is going to just last for a few quarters, a few years? I certainly don't. I think this is here to stay.
Yeah, I think it's a couple things. So if we look at this, there's going to be the big move higher, and then it's going to consolidate, and then it'll move higher again and consolidate. And every single consolidation will be great buying opportunities, and most people will go, well, I'm not going to buy it because gold can't go up anymore. It's gone up too much. So it's keeping an open mind to continuing to buy the breakouts within an uptrend. Sam and I, we've been buying gold since there's a false breakdown signal going back to 2023, then the breakout in January 2024. and then where we're at today. But on the way up, we've given people opportunities. Hey, it would hit out a flag pattern at some point. We gave them the opportunity to buy that. It had a pennant pattern at another point. We gave them the opportunity to buy that. We've also generated alpha by putting on the mining trades inside of this. So there's just been so many ways to take advantage of this trend. And relative to the S&P 500, most of the time what this is saying is that the market's not in great shape during this time. In 2003 to 2008, the market did go up between that period of time, but it just was a lot less than everything else. A lot less
It
than
was more
gold.
mean reverting in nature. It was coming off
Yes.
of that big crash.
Yes, it just went up for a few years. I think it was 70% from peak to trough.
Yeah.
So it made a 70% return, whereas Latin America was up 600%, Brazil up 800%. China had a great period of time. I think 300 something percent. So once again, it's a continue to just look at these other areas. If we continue to stay in this weak dollar environment and don't get too hung up on, hey, I got to be in the S&P 500. Hey, I got to pick these bottoms. Just think of, hey, if the market gets to here, I might be a little bit more bullish on it, but that doesn't mean you have to buy the S&P 500. For me, I like to look at levels and go, okay, this is where the S&P 500 is safe. What sectors inside of the United States would I want to buy if the S&P 500 is in an uptrend? Where's the outperformance? And still, I'm looking at gold miners. I'm still looking at the copper miners and possibly energy if that can ever take out the old highs. If it can
Yeah.
take out the old highs, I'd be very happy to say energy could really start taking off. But right now, oil doesn't look like it's doing too well. Those mean reversion trades are about all you're really going to get out of oil at the moment.
Well, let's talk about the energy, Jason. So in Q1 of 2025, you saw the XLE, that's the energy sector spider, the energy sector of the S&P 500. It was up by far the most out of all 11 sectors. As you can see, it's in the top right here. And then you had healthcare, utilities, consumer staples. They also did pretty well. But you saw dramatic underperformance from consumer discretionary and technology.
Yes. And I love these charts because it just kind of shows you like where the money's going. And you want to continue to just follow where the money is going. But also you want to know where the S&P 500 is. For example, the S&P 500 is under a 10-month moving average. You want to start to really pull back your exposure to the S&P 500 under the 200-day. However you want to look at it. I like to use monthly closes. I think that's the best way to do it. You get a close under the 10-month moving average. Maybe it's time to start looking for exposure in other areas. And we're getting very close to that, possibly this month. So, continue to pay attention to this. I think we are in April. Usually we see a nice rally in April.
That's right.
And this is what Sam and I talked about the other day too, and this is important. If you see this market in April continue lower here, that is a very bad sign. I think that's a terrible sign for the market and something that we should really look out for. If you see
I
this
think
market,
that's how you should use seasonality, Jason,
yes,
is usually it just tracks seasonality and like, yep, that's great. Check that box. But whenever markets do not track seasonality, that is when we need to pay extra close attention, right?
yes, exactly. So let's, just everybody just have that one on your radar. If this market can't do anything in April, that's probably not a good sign for it going into the summer months where it normally does nothing. And also, I want to ask you guys, if you guys have some questions, go ahead and throw them in the chat, and Sam and I will try to get to them before we get going. So if you guys have any questions and you're on YouTube, throw it in the chat. We can't see your comments on Twitter. Sorry about that, guys. But if you guys are on YouTube, feel free to write in, say, hey, I want to see this. Hey, Jason, that was really cool what you said. Hey, Jason, that sucked what you said. Whatever it is, we want to hear from you guys. So we'll go through one more and then we'll hop off from there.
For sure. Yeah, let's talk about the positioning in the crude oil futures. Historically, it's been a great strategy to fade the money managers section of the commitment of traders report. And right now they are carrying their largest net short crude oil position ever. They have never held a larger short position. As you can see, back in 2016, they were also super short, and that ended up being a terrible trade. You wanted to be buying crude oil very aggressively at that time. So, do you think it's going to be different this time? Do you think these money managers are going to be right, and there's some crude oil crash coming, or you think you can just keep buying this dip around 65 or 70? I think the support will continue to hold.
It's a tough one, and you and I talked about this the other day because the more times, and to your point, the more times we hit this bottom, that 65 level over and over again, the more it's telling us that we can break through it. That's technical analysis 101. So what I would like to see is us actually take out that $80 level. That would get me very bullish on oil. Until then, it's like, I do think that this thing is a little bit oversold. And I do think we could see this bounce kind of come into play. But once again, it's like you're playing for a bounce here. And if you want to, and if you're a range trader or you have a reversal model that you run, take the trades, go ahead. I have nothing wrong with that. But if you're actually trying to ride a trend and think, energy's or energy's going to go up and crude oil is going to go to 130 or something, you really got to wait for it to break out of 80. If it gets out of 80, that's going to be the time this thing really takes off. The short position is starting to flip. Sam and I both know that, once that starts to flip the other direction, that's when we start to see the moves actually start to happen.
That's so true. That's like the real value from the CO2 profile, I think, is it's not so much whether or not they're carrying huge short positions or huge long positions. It's more about when that changes, because that so many times that has marked inflection points.
Yes, and so that's the inflection point that we really need to look at. So I think going forward, right here is a good idea to just kind of sit on your hands on oil. If this thing breaks down, get ready to short it. I would take it either way. It goes over 80, I want to be long in. Gets under, I think our signal's at 63. I want to be short it, and that's it. I don't care which way it goes. I think you just got to take that trade either way because it is in such a tight range. The move's going to be explosive up or down. Take it either way.
Definitely, Jason. You've been talking about that for so long now.
It feels like forever.
The Bollinger Bandwidth has been super tight for a long time, and granted, that doesn't tell you which direction it's going to go, but boy, does it tell you that the resolution of that range will be explosive. So if we get above 80, yeah, we're probably heading into the 100s for crude oil, and on the flip side, if we break that 60 level, we're probably heading into at least the low 50s. 40s, we could be seeing maybe not negative crude oil again, but
probably not negative crude oil, Sam, but I do think it can definitely head lower. So we've only got one question on utilities. So real quick, my thoughts on that, and then we'll just get out of here. So my thoughts on utilities. I would continue to look at those if the bond market is doing well. Utilities could do well. It's not I think that's cool. One thing I really enjoy is that somebody would actually bring up that topic because, there's been years where utilities have been a great performer. 2019, it was one of our best performing trades. We had a options trade in it all year long. It did really well. It's a smooth trending product, so you can buy long dated call options on it and trade it almost like you're holding the underlying stock. So I definitely like that XLU is brought up today. So continue to look into those names. It could be interesting, especially with the setup in natural gas compared to the setup in bonds and oil. It's probably a good place to start looking.
For sure. Yeah, and we've seen the utilities outperform for very long periods of time. We were talking about that stretch from the dot-com bubble peak to the great financial crisis, and there was a lot of utility outperformance during that time.
Yes.
Well, Jason, let's wrap it up here. We want to tell you all about what we do at the Gold Rush. Each week we publish the Gold Rush report on Mondays, where we specifically cover the precious metals complex. That includes gold, silver, platinum, palladium. We've been highlighting a lot of miners lately. We've seen some new all-time highs in the precious metal miners. The GDX alone was up over 30% in Q1. It was incredible. We were talking about energy stocks leading the S&P 500. Energy stocks were up not even 10%. So these precious metal stocks have like tripled the best S&P 500 sector so far this year. And again, we're trend followers, so we think that trend is going to persist for the foreseeable future. So yeah, on Mondays we do that, and on Fridays we cover all things commodities. So that includes energy, base, and industrial metals like copper and aluminum. We've been talking about orange juice, just had its worst quarter ever. We covered the cocoa run. That was incredible. I know your fund made a fortune on that cocoa
That's a good
trade.
one. Yeah. Natural gas. We've also been talking about that. We cover it all, whether it's the individual stocks inside of it or the commodities on top of it. And also, just so you guys know, it's a 30-day money back guarantee. You don't like the product, you think Sam and I are too cool for you, because obviously we wouldn't be stupid. They would just think we're too awesome. So if we're too awesome, you can have your money back. We totally understand. Sometimes our awesomeness kind of gets in the way of everything. So, money back guarantee for 30 days, you can't really beat that. And so, we want to thank you guys so much for joining us today. And feel free to write in, ask us questions, leave comments, and share this, because I think a lot of people could benefit from this type of research to just understand what we're doing today in the markets, understand that, hey, let's not overreact on the move today, and let's continue to ride the trends as they come.
Absolutely, Jason. Let's leave it there. Cheers, everyone.